folks. Let's keep the momentum here. You've heard from some great entrepreneurs. It's time to hear from the investors who make them grow and sustain them over time. So we have a fabulous panel. I'm not going to reintroduce them. Chen already did that, but I think I want to give them an opportunity to kind of briefly introduce themselves and talk a little bit about their organization and what their organization focuses on, in particular what they do with it.
Okay.
Elizabeth, you want to start us off?
Good afternoon, everyone, or good morning. Elizabeth Cho-Fertique. I'm a Hopkins alum, the undergrad, so they're always happy to come back here. I started out as a scientist, but edged slowly over into the investing side, kind of accidentally, but here I am. Meta Ventures is a VC that spun out of an angel investor group that I began with some physicians, Meta Angels. That started out in 2019. It still continues, but we thought maybe we could graduate. So here we are. We had a fund one, and that's about nearly deployed, and now we're got onto a fund two. We invest in anything healthcare, anything, particularly at the mid-seed and Series A stages. And we do invest, obviously US-based, but on occasion internationally. We can diligence, and there are no tax implications. So that's me.
Thanks, Elizabeth. Jeff?
Good morning, everyone. My name is Jeff Cherry. Speaking of an accidental investor, I would definitely be the definition of an accidental investor. I run a couple of organizations here in Baltimore, one called the Novella Center for Entrepreneurship, which is a not-for-profit that runs an accelerator called the Conscious Venture Lab. January 7th, demo day here in Baltimore. As Troy said, I want everyone to be there. Look me up on LinkedIn. And then I run a venture capital fund here called Conscious Venture Partners. We're on our second fund, almost fully invested, just about. The accidental part is I also didn't start out as an investor. I'm an architect by training. I went to college in Washington, D.C. at Catholic University, started an architectural firm in Washington that over the course of about 20 years, I turned into a management consulting company, grew from 2 people on the second floor of a bedroom in DuPont Circle to about 200 people around the world doing management consulting and working with Fortune 500 companies down to startups and government. Over the course of that time, we started to see the emergence of this idea that we now call stakeholder or conscious capitalism. So everything that we do now, I sold that company, I started a hedge fund, I moved back to New York, and then moved to Maryland because I wanted to get into the early stage investment business. Ken Ullman was a county executive in Howard County, heard about what we were doing, and asked, how do I get you to start this business in Columbia? I said, where the hell's Columbia? He sent me a MapQuest. I found Columbia, and we moved here and started the Conscious Ventures Collective to invest in early stage founders. What we do is we have sort of 3 themes that we focus on. One is this idea that we think that the winning businesses of the future are not going to focus myopically on shareholders. They're going to actually understand how to create value for all their stakeholders, so stakeholder or conscious capitalism. The second idea is that we want to invest in ideas that we think are breaking down barriers to access in society in some way, so making society more equitable, more just, more joyous, and more prosperous for everyone, more sustainable. And the third idea is that we think that there's really, really smart people everywhere. There's just not opportunity everywhere. So we do the best that we can to get into communities of underrepresented founders and find ideas that other people are ignoring for the wrong reasons. So that's what we do.
All right. Hi, everyone. My name is Deborah Hemingway, and I'm the founder and managing partner of Egg4 Capital. We are an early stage med tech VC firm based right here in Baltimore. And we look for companies that match two key focus points for us. The first one is that we are Maryland-based. We're Maryland-based, Maryland-founded, Maryland-focused. I mean, why not? There's so much incredible innovation here. So we capitalize on that. And we leverage the Biotechnology Investment Incentive Tax Credit Program. That's the BITC program on all of our investments. So we're really proud to partner with the state and to have access to this program. And I'm really excited to see it ramp up. And really support our amazing companies. So all of our companies are in Maryland, like I said, and are also committed to staying here for at least 3 years. The next thing that we do is we're looking for companies that have a really strong foundation. So we like to invest in Series A. We will go earlier than that. We look for companies, though, with 4 key parameters in place. So the first one that we look for is a very strong and intimate knowledge of the product market fit. So what is that pain point that you're trying to solve? Really, that's the heart of the organization. And we also do quantify that, which, yes, is a little bit nerdy, but we love data at my firm. So we do place quantitative values on that product market fit. The next thing that we look for is technical feasibility. If you don't have a fully functioning prototype, we look at the components of your prototype and what does it take to get there, and to also be commercially ready. How much more development is needed on that? So product market fit, technical feasibility. The next thing that we look at is the patent portfolio. So how strong is that protection? What does it look like? Do you have room to innovate and grow? And what's the patent landscape that you're participating in? And then finally, we begin with the end in mind. So what is your exit strategy? What type of returns are we looking at? We are driven by returns, so we do look at the financial returns as a very solid and key component of what we're looking at. So yeah, that's what we're looking for. Maryland-based, strong companies.
I'm Jack Miner. I'm the Chief Investment Officer with Maryland Tedco. I'm delighted that my boss stayed in the room for me to give this presentation. So you can all fill out my annual performance review after I'm done with this. But let me just start with a reminder, December 4th, go to the, right? Did I get that?
Yes.
Get to the Entrepreneur Expo. Tedco, the team I manage in the investment side, we are an instrumentality of the state, strategic direct investor on behalf of the taxpayers. We have $200 million in assets under management. Bulk of that is locked up in our current portfolio. We invest about $20 million a year, as you heard Troy say earlier, from $100,000 to $1.5 million. We are designed by statute. We execute based on what the legislators want us to do, and I think we do a fantastic job of it as an organization. Not me, but the team does a great job of that, working with partners like you have up here in finding ways to invest in early stage technology companies in the state of Maryland. We have 3 asset classes: social impact, seed, and venture. Venture is what you would expect it to be. Seed is really driven by, again, by statute, life sciences, cyber, tech transfer, and gap, which is as you expand your company, you can apply for funding. And then social impact, which is probably one of the things that I'm professionally most proud of. We invest in, purposefully invest in, and purposefully fill top of funnel for companies that are founded by people of color, women, vets, and disabled. And I think that it's profoundly different than the rest of the country. The average number of women who receive venture capital is somewhere between 0.01 if you're a Black woman founder and 2% if you're a white woman founder. We're at 56% in the state of Maryland. So that's all based on statute. We're doing this on behalf of the legislators. Your elected officials want to put their thumb on the scale, and I think we're executing on that.
Great. Well, thank you all for that introduction. I thought it'd be fun for everyone to hear an example of a recent investment or recent exit that you've had, some great story that you're really excited about. So, and Jack, for you, it better be a women-owned company. So, Elizabeth, do you want to start us off first?
Sure. Gosh, which one to choose, right? It's been a really, our first fund has been doing quite well. We only started last year, although fully deployed almost. There haven't been exits yet, but the companies that we have found, we invested in, the teams are just, incredible and tenacious, and they're pushing forward and hitting milestones that they said they would, which is unusual, on time. It really, it's just been, they're just tough as nails. So that's been really one good thing. I would say a great case that we invested in is a medical device company called Atraverse Medical. We invested at the beginning of the year. It's a left heart cardiac catheter device. You don't have to use multiple catheters, one and done. But anyway, very close to, after we invested, boom, they got their FDA approval. We weren't sure, but, all the signs indicated. So that, obviously helped the IRR. And then after that, this team, it's a serial entrepreneur team, they rapidly got 50 cases, human cases, under their belt in about 3 months. Boom, 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 boom. And they're already selling 80% margin. I mean, these guys are on fire. So thank you. And thanks to the patients. But I mean, quite a number of the companies that we have selected are marching this way and meeting the milestones as they said they would. And we're pleased, as punches for that. So that's it.
You're picking them well.
I guess so.
Jeff, what about you?
Yeah, it's a tough question, which ones to
Yeah.
choose. But I think I'm going to focus on an investment we just made here in Baltimore, probably about 6 months ago. A woman named Dawn Myers, a company called Ritualist. The reason why I think that I don't know this for a fact. I'm making this all up, but I think we're one of the venture firms, certainly the venture firms that had the most companies on Shark Tank. And Dawn was on Shark Tank and got a deal with Emma Grede and Mark Cuban, and we were investing right around the same time. But Dawn's been through such an incredible personal journey. Some medical problems and just, but we just love her tenacity. We invest very, very early on. We're usually the first or very nearly the first professional money into the companies that we invest in. So, as some people who know me here, Tien and Troy know, I'm a degenerate horse gambler. So I'll be at the Maryland Million this weekend. If anyone's going to be there, come see me. I'll give you some tips. But we really bet on jockeys and not horses. So we're betting on people because we know that at the earliest stages, there's a few things that we know for sure. And one of the things we know for sure is the business is likely to change. So we're really betting on that person and their ability to achieve. And we just really, I fell in love with Dawn, her story. Her product is one of those ideas that lots of people ignore because they don't get it. Her product is a device for a Black woman's hair. And for grooming, and when she tells the story, it's so compelling. I have 3 sisters, but I don't know a lot about Black women's hair. But I do know that Dawn is going to figure out how to be successful, and that's what we really love to invest in. People that we know are going to figure it out sooner or later. We think this idea will work. It may not work, and if it doesn't work, the next thing that Dawn does will work, and we want to have been one of the people that who supported her from the very beginning. So we're really proud of that and, trying to continue to support her.
Great. I personally love great hair-related entrepreneurship.
I was going to say right up your alley, Dean. Yeah.
Deb, what about you?
Good. I'd like to share a story that highlights the importance of having a relationship with your investor if you're a CEO. So hopefully this will inspire some CEOs out there. So I got started in angel investing almost 7 years ago now. And the very first company that I invested in as an angel investor was a company that barely had a prototype. They'd come to the University of Maryland College Park, Dingman Center Angels, where I was a new angel. And they pitched there. It's the very first pitch I heard. And I ended up investing in this company. So this company is CONNECTpreneur. They're here in Baltimore. And so they had ups and downs, as any startup does. They were trying to sell into the hospitals during COVID, which you can imagine how that went. So that was a hard time for the company, but the company just built a solid relationship with myself and the other investors. And, this is find investors who are going to back you and believe in you, like even in the hard times. So fast forward now almost 7 years from that investment, the company was continued and thrived. Now that COVID has lifted, they're getting back in the hospitals and making sales. And I'm very proud to report that since I'm no longer an angel, I'm now managing my VC firm. In August, my firm put in 1.2 million. So that's a deal that we just closed, and I'm really happy about that. And to continue to support this founder. And so I would just say, I bring up the story to say, be sure that you're building a great relationship with your investors and keeping them in the loop with what you're doing, and they'll continue to support you. And we're also open to doing another follow-on with this company as long as they continue to meet their milestones. And so, that's a deal that we did that we're happy about.
Thanks, Deb. Doc?
I'm maybe plagiarizing a little bit. I think, what the most important thing is that communication with the investment community. And so one company that I'm really proud of where we're headed was a complete failure. We invested millions of dollars in this company, and it failed. And we didn't hear anything from the founder and didn't hear anything from the founder. And finally, we heard something back from the founder, and we're like, dude, you got to understand, we want to talk with you. This is a building block, right? This is a stepping stone. And I think that, so as far as messages go to the community and where we have a dual mandate: economic development and financial returns. Are we upset about the fact that we are not going to get any financial returns? Of course we are. We don't want that to happen. But at the same time, we want to celebrate the fact that this individual failed, learned from the failure, learned to communicate with the investment community, and recognizes the value of that, because we threw our arms around him and we made sure that we understood where he was coming from. He's not proud of the fact, but we're proud of where we're headed. And I think that that's something that's often overlooked. Deborah alluded to it in terms of communication, but I think that those stepping stones and those building blocks are really, really important to us in our dual mandate of economic development and financial returns.
Thanks, Jack. So Chen, I know you wanted to leave some time for open Q&A. So what, should we start that now, or? Okay. So we'll open it up to the audience for our fabulous panelists here, if you have any questions for them. You tell them what the special prize is? Yeah, please. Well, behind you first and then you. Yeah.
I'm actually going to ask a question to the dean, which is, there's a terrific thing that happens where academia, government, and industry come together. And obviously the school is at the center of the academic universe, at least here. Can you give advice to small business owners on ways in which they can engage with the school and the best way? Obviously, small business comes with some expertise and always lacks others. And the school is a huge wealth of business expertise. How can small businesses interact with the school in ways that are constructive in their own growth and development?
Yeah, thank you for the question, and it depends, I think, on the university itself. So here at Hopkins, we have a central engine called Johns Hopkins Technology Ventures that we work very closely with, as do other schools on campus. So I think last year there was about 140 student-based teams that were supported by JHTV in one way or another. And then many of our alumni, but also community members that want in particular to establish a footprint or expand their footprint here in Baltimore can get involved. So that would be sort of the best front door I would give to you, although certainly reach out to me as well. But I think you stated it right, that everybody's looking for something different. It might be investment, it might be sort of the right partner, it might be student talent for people that you want to hire to be able to, and we can certainly help with that, as can other schools. Other schools, I used to be at University of Maryland, they have a particular center, the Dingman Center, within the business school, right? So different universities, I think, are set up in different ways. If any of you want to connect, I'm very open to that. Absolutely. Thank you. Yes.
So what type of programs are available, whether they're venture-backed, academic, or state-backed ventures, for more seasoned executives to come in and serve as advisors for these fledgling companies? Those who have already gone through the rodeo, so to speak, and now can provide their insight and guidance and connections.
ConsciousVentureLab.com. Go online and sign up. We're always looking for mentors. We've got about 120 mentors in the program for the accelerator right now. We're proud that, lots of really well-known names. Our first mentor was Tom Gardner, CEO of the Motley Fool. But we've got 120, but we're always looking for mentors because we agree with you that no better talent. I mean, I've been at this for a long time, but no better talent than someone else who's been through the race before. So that's one way to get involved. And there's a bunch of accelerators. Social Innovation Lab at Hopkins. There's all sorts of accelerators, Ignite Capital. So I think that if you're in that, an executive who's had a business, still doing it, but want to get involved in the early stage in the startup world, that's easy to find here. Really easy to find here. Just yeah, okay.
I don't know if you want to add.
Yeah, just real quickly. I mean, very similar. TEDCO has loan executives programs and EIRs available. Jeff said it earlier. We bet on the jockey. You're an additional jockey on the horse. Not that that's a good analogy, because that's probably going to slow it down. But
Trainer, yeah.
Yeah, but certainly there, and I think you connect with one, you're probably going to connect with all those groups. So seek out any of us.
MTC VMS.
Oh, go ahead.
And MTC VMS, also give them a shout out.
I'll also add our angel investor group, Meta Angels, is still ongoing, and we often have folks who've been through the rodeo asking to advise startups as they come and pitch. So you're welcome to check us out as well. So we have most of the angel investor members are from the obviously healthcare sector. Many are physician investors, some from industry, so forth. So that network in and of itself, they seem to enjoy the camaraderie amongst themselves too. So there's an option.
Great, thank you. I think
Yeah.
I was just going to plug a couple of resources. Oh, thank you. As a founder who's received investment from TEDCO, from Dingman, and has benefited from resources that the Carey School of Business offers. I run Femly, a feminine care company that has dispensers and bathrooms around the world. And we leveraged the Johns Hopkins Scope-a-thon to have a one-day access to like world-class MBA and like finance students who helped us refine our go-to-market strategy, which saw us through a transition from direct sales to a restroom leasing model, which I think is the thing that will get us exited. We also used the community consulting lab, which provided valuable resources for like building our team and IP strategy. I have used the loan executive program with TEDCO and love it. And so I think that like one of the assets that you guys particularly offer is uncomparable access to like resources that really help you as a founder build capacity and like refine the company. And I see this more in Baltimore than I've seen anywhere else.
Thank you for plugging our programs here at the Carey Business School. But it's not only great for all you founders and as you're building up your company, it's also great for our students as well and the experience that they get. So win-win.
Our CFOs are MBA students.
Yeah, what's the state of capital? Are we seeing capital loosen up for investing here as economic changes have seemed to hold here? What's your view, maybe 6 to 12 months down the road?
Great question. Who wants to take that?
Yeah, and are you talking about? You're talking about life sciences, right? Biotech.
I'm talking more general.
Oh, okay. They haven't trended generally together. It's gotten better, but biotech actually has been pacing well. So yay. As for other areas, not so much, I would say, med tech. It's still, it plummeted the most out of all. Med devices, pretty much stable, although on the lower end. Biotech is coming back up. So it's different per sector. Yeah, I'd say that.
Any other?
I would just say something overall about the state of capital. You said something earlier about companies meeting milestones, and that's, I can't tell you how important that is right now. Execution is the thing that matters. We tell all of our firms that the best venture capital is a new customer. When you really don't want money from me, you want money from someone who's paying for your product, because capital is getting really hard right now overall, right? The FTC and the Department of Justice are looking at M&A. They're going down market, so looking at smaller deals, which is tampering down M&A activity globally. I think the most recent data we have, the Fortune 500, the number of deals, M&A deals that they've done shrank by something like 25 or 30% year over year, but the value of those deals went up. What does that mean? They're looking at bigger deals. So earlier stage companies that means valuations are compressing, and it's harder for funds like ours anyway, the smaller funds, to raise capital because, because we're not participating in those large deals. High interest rates, tamp down IPOs. So all of those things are really impacting the earliest stage. So for founders, you got to really, really focus on execution. When you set up a set of milestones, if you have to meet them. We have actually turned down companies that are in our portfolio for follow-on investing because we said, you set the milestones, tell us what they are. If you meet them, we'll follow on. They did not meet them. We're like, we are sticking to our knitting. We're going to put that money where we think it's going to be most valuable for our LPs. So you have to hit your milestones. I think that for others in the room, or either who are potential investors or investors, we need that money to get off the sidelines too. So I think that's the state that we see is a little bit more complex. Looks like that.
I think, it's not a nuclear winter for venture, but it's pretty darn cold right now. Unless, like Jeff was saying, unless the M&A and IPO market opens up, there's so much trapped capital in the portfolio. Nobody's going to do any more investing. But I wonder about the, breaking up big tech, what that would do to us as a community. I think, you're talking about FTC, really going downstream on that. I think they're also looking at the Metas and looking at breaking that up. And for us, I think that's a good thing because there's more competition. Big tech kills small tech. And so I think there's some really, interest rates are going to come down. It's going to open up the IPO market. M&A is going to start to increase. I think it's gonna, but I think there's also that big FTC shadow on the horizon.
100%.
Depending on the administration, right?
Yeah.
We'll see what happens.
Although I think the FTC chair was, she's been there for 3 presidents. Is that right? Anyway,
Yeah.
We'll
don't
see.
talk politics.
So in the back there, I think is our next question.
Good morning. Danielle Christine Toussaint, founder of Purple House. It's a creative intelligence agency. And my question is about where you're seeing opportunities at the intersection of the creative economy and technology. I know a lot of the panel is focused on technology as it relates to sort of bio and health science, but Baltimore in particular is also home to a very vibrant, creative community. There's so much entrepreneurship. We have, sort of a world-class art institute. And I was just there last week with a lot of students talking about all of the other ways where there's like an earlier bar, sort of an easier and lower bar to entry for creatives. And the creator economy is really accelerating. And so I'm just curious where you see the opportunity to invest there so that we can sort of grow that ecosystem that's local.
Okay.
Come on, Deborah, answer a question.
So
I
look,
can comment on it too.
I think that we spend a lot of time in the creative economy. We helped run an accelerator at MICA. And I think that if you want to be a creative and stay pure in the creative economy, it's really difficult for the venture community to help, because we spend a lot of time educating our founders about why venture capital works the way it does. And a lot of it has to do with how do we return money to the people who give it to us to invest, right? So simply said, the exit opportunities for pure creative companies they're few and far between depending on what they're doing. I think that the opportunity, in my opinion, for creative companies is for them to add that creativity to other things. I'll give you an example. We think that Baltimore, particularly Baltimore, can become an epicenter of things like smart textiles, because you have Micah, you have Hopkins with the hospital and medical, you have Under Armour, and you have all these things about wearables and how do we understand what's happening with our body. We think that if creators, sort of expand their vision a little bit of how they can bring their creativity to other industries, we think that's sort of the way to go for us.
This is way out of my wheelhouse, but I'm going to try to say something here. Because my daughter is a fine arts major at Parsons School of Design. She went way the other side of the family. But watching her, no, she's the creative. We're the analytical. Watching her and all the students and millennials and so on and so forth. New York is a vibrant, obviously, community, and there are venture ecosystems there. The digitization of art is one area where scalability is possible. And I can just do the math of it and see how that may be attractive. It's not an area I invest in, but I think maybe that particular niche could be fostered more. As for straight art, fine art, that I don't know how to speak to that part. But yeah, digitization, possibly.
All right, and I'll comment on, the fourth thing that we look for at my firm, and that is the exit. What is the exit strategy? And Jeff alluded to this also. If you want to bring in venture capital money, what type of exit can you deliver, and what type of returns can you deliver back to the investors? So starting with the end in mind about what that opportunity is and what the end goal is a way to think about it, as you begin to seek out additional capital coming in. For us, our companies to have a first conversation with us, they have to at least show us how they can get a 10x. Okay, look, since we're a VC firm, we want more than that. I mean, look, we want 100x. Who doesn't? Okay, we're very open about that. But for us, the barrier is 10x to get in. So as you seek out capital, it's just a good understanding of what the investor wants in return. What type of multiple are they looking for? And then once you have that base, then you can know if it's a good fit, and if you can pursue that option.
Ashton, I think you were keeping track here. Thank you.
Hi, Mia Horm. What recommendations do you all give to founders who approach for potential funding with you to prepare on the legal side for IP protection? I'm specifically wondering about those who are building on large language models. Can you talk a little bit about how they should navigate that before they come to you? Like what resources maybe they should tap into?
Yeah, so for us, we do expect a freedom to operate to have been conducted by a national firm, but we're looking more towards Series A as our target, and we know some of the earlier companies may not have a robust freedom to operate in place, or may not have all their ducks in a row in terms of their patents fully executed. But for the first stop, there are clinics around me going back to very beginning, securing just provisionals and getting a patent strategy in place. You don't have to spend $100,000 right up front, but if you do have a small budget for legal, that could go a long way, especially if you can leverage clinics and other maybe attorneys who can work on deferral and other arrangements like that to get a certain foundation in place as you begin to build out your own patent portfolio and considering what type of patents you can get there.
Yeah, I think, next with Shulman Rogers would be a good place just to I know some of the work that they do. You're welcome.
Yeah, and they have flat rate services.
But I worry about LLM, AI, the curated data. As an investor, I feel like that is really speed of execution and less about copyright and patent around that. I mean, there's a lot of patent law around copywriting a process, a software process, and the complications associated with that. Preserving your curated data is probably the biggest thing. And Lord knows the data that we see, garbage in, garbage out, right? And if we can figure out a way to do a blockchain wrap around the data and know the provenance of the data, especially for healthcare models, that's huge, right? So I think that's the approach I would take with an attorney is, look, this is not a patent like you would see with a therapeutic drug or a medical device. This is more a copyright and go down that path. And again, I'm looking at speed of execution because it's going to be really dynamic who gets to market first.
Okay, time for one last question.
Hi,
Sorry.
Oleg Shinkush from Chromaton. I presented earlier. Pleasure to be here.
Sorry, I can't hear you.
Oleg Shinkush, I'm CEO of Chromaton, presented earlier. I have a question about more on the side of the life science market and how you guys treat non-dilutive capital and what is the impact of non-dilutive capital on how you view company valuation, as well as kind of the chance, as well as kind of the chances of companies that have that significant expertise versus companies that don't.
Yeah, can I start, because this will be interesting to see going down the chain. So we might be first dollar in for $150,000, $200,000 as an investment. We're looking at the non-dilutive capital as, you've really done a great job of moving that technology along. I will tell you, we don't sweat valuations very much because we're so early on. We know the valuation's going to change. So that, we don't really bake that non-dilutive funding into the valuation of the company. But I'm going to pass it off just like I would any other investment.
Yeah, no, we love it. I mean, we love to see it. I mean, we haven't invested in a company that hasn't had. I mean, I don't know the amount, but I mean, at least $500,000 in non-dilutive funding. So we love to see it for us. It's a good signal. It's a good marker. It's so expensive bringing, especially in the medical space, so expensive bringing these. And so bringing in non-dilutive capital is really, that's the way to go.
We don't do a lot of life sciences, but I will say that the way that we think about that is what's the price of incremental certainty? So dilutive capital should allow you to sort of compress that, right? So to lower the risk for your next investor. Taking that money, here's how I've lowered your risk. If you've done that, then the impact on valuation can be it's less risky now, right? If you haven't done it, if you haven't used that capital to actually lower the risk, it's a great signal, right? It might be, okay, we appreciate the fact that others are interested, but I would say focus on using that capital to lower the risk for the next investor.
Yeah, that's a great point. And then if you got non-dilutive capital, then what did you do with it? Did you meet your milestones? Maybe you got rad X, but then you missed phase 2. I mean, so yeah, great point.
So with us, we of course love non-dilutive because it gives us even more piece of the pie, right? And besides the validation, but I have seen companies use it both ways in terms of valuation. Because they've gotten a lot of non-dilutive, they can afford to lower the valuation to help bring in capital, which makes it attractive for investors. But they have to balance not lowering it so much that it's like, what's the matter with you? You should be worth much more. I've seen them play it to their advantage very nicely. So it's not like one on top of the other, right? 100 from SBIR, 100 from, you know, investors, 1+1. Not quite that way, but I have seen people play with it very cleverly, and we get it and we appreciate it. But in the back of our minds, yes, there's less dilution for everybody all around. Great. Scientific validation probably as well. We know so, yes. That's what we see it.
Great, thanks, Elizabeth. Well, I see Jen standing up, so that's our sign. Get off the stage, but thank you to all of our panelists.
Yeah.